Well, hello everybody and welcome back to the All Saints podcast. I'm very excited to bring you today's guest. This is in part in response to a question I received from a member of the congregation. In part, it's something I've been wanting to do for a while because today I have with me Mr. Drew Dill, who is a wealth manager, a wealth advisor at the Bahnsen Group, which manages over $4.5 billion of client capital. Drew is a chartered retirement plan specialist. He's been working with the Bahnsen Group for a number of years and has wide and deep experience in the financial industry. And the issue I'd like to talk about with him today is the issue of debt, the broad subject of debt. In what circumstances is indebtedness a good idea? In what circumstances is it a bad idea? Now, obviously, there are biblical coordinates that will inform our conversation about this. But when I received this question from a member of the congregation, and it was a kind of specific question about a particular kind of investment, I thought, yeah, this is one sub-point in a whole domain of Christian discipleship where we as Christians could really benefit from hearing from a Christian financial advisor with the expertise and experience of Drew Dill. So, Drew, thank you very much indeed for being with us today.
Yep, glad to be here. Thanks, Steve.
Give us a couple of sentences just so we can get to know you a little bit better. Tell us about yourself and your work experience and family and so on and so forth.
Yeah, I've been in the financial industry for over a decade. Most of that was with a major national bank for about 9 or 10 years. And providentially, I had a great friend of mine who worked for a small firm called Bahnsen Group, which he said he think I'd be a good fit, and providentially interviewed Bahnsen Group and have been here as a financial advisor, private wealth advisor for 3 years. Grew up and born and raised in San Clemente, and also happened to be a Protestant of the Reformed variety within the Orthodox Presbyterian Church for over a decade. Still in part of that church, and happy to be here. So.
Well, listen, it's a real pleasure to speak with you, and I'm looking forward to hearing your wisdom. So let's just jump straight in. And as we're going through, I'm going to be conscious of wanting to allow the biblical coordinates to set the questions alongside the kind of things that people just raise. And then hearing your input as a financial specialist, as well as a Christian with some experience of these things. And the first thing that often arises, especially among conservative Reformed Christians, when we talk about this topic, is like, well, why on earth are we talking about debt anyway? Like, doesn't the Bible just say debt is a really terrible idea? None of us should ever be in any kind of debt at all. And then you've got the specific prohibition in Leviticus 25 against usury. Before we jump into, I'll make a couple of comments about that text particularly. Is that a viewpoint that you've encountered, and how do you react to it?
Yeah, I've gotten the question quite a bit from good, honest Christians who want to be faithful to the text, and they read the prohibition. The simple answer is I would say no. Lending is good. The broader answer is saying we live in a world, not only in the United States but in a global economy that is built off of lending, for better or for worse, and it's completely unavoidable. Whether you own a treasury bond or municipal bond, whether you take out a loan to buy a washer or a dryer or a credit card, or if you put money into a bank account, they're taking your money and they're lending it out. So you can't avoid it. 1, 2, the biblical prohibition, I just think needs to be set in context. Leviticus, for instance, my take on this, and I'd love to hear your thoughts on it too, Steve, but my take on this would be the context of Leviticus. In the context of the Near Ancient East, when Moses is writing, the first 5 books, is most of the people were dirt poor, and you didn't have a lot of wealthy. You had a very small minority of wealthy people. You have a theocratic institution that God is setting up to be a foreshadow of the kingdom that Jesus is going to bring. And that's the theocracy of Israel. And that law, I think, points to the fact that Israelites need to take care of their fellow Israelites and not exploit them, to be a covenant community that is caring and nurturing, and to not have very few people who have money who then lend to others who are dirt poor when they need to buy basic material things like food, right? So that's kind of the context of that. you also notice there's a caveat. I think it's in Deuteronomy, where it doesn't say that you can't lend money without interest. It says you can't lend money without interest to an Israelite, but to a foreigner you can. And
Right.
I think that there's a huge distinction to say, as Israel's set up to be a foreshadow of what the church, the assembly of God, when Jesus comes and establishes it, that theocracy is to be a foreshadow of what the church should look like. And so, if you're at All Saints, and you have money, the last thing you want to do is exploit somebody to make money off of for a fellow member, right? It would be just counterintuitive to the church. And so I think that there's a key foreshadowing aspect there, saying Israelites need to take care of their own, as the church needs to take care of their own, and there should be zero exploitation. But it says to the foreigner, you can. And so I think that's a great caveat. Just say God said, he's not saying lending is bad. He's saying, exploiting your brother or sister is bad.
Yeah, no, it makes a lot of sense. I mean, and your insight into the context is precisely in keeping with what I want to say myself, and it's actually highlighted even more sharply because the point in Leviticus 25 is that these are loans to your poor brother. And so that, again, it draws attention to this distinction that you're highlighting, that socially and demographically, you have a small wealthy class and lots of impoverished people. And the point is, actually, you can and should lend to those who are poor and are in difficulty, but you shouldn't charge interest to them. And it's the charging of interest that is to be paid by people who ought to be recipients of poverty relief. That's the problem. In other words, what Leviticus 25 is doing is presupposing a certain kind of lending for the relief of poverty. And it's saying in that context, don't charge interest. What that means then is that in the broader framework, as you mentioned, Deuteronomy, of course, that presupposes other kinds of lending as well, where interest is legitimate. And in effect, what you're doing there is you're reflecting the cost of capital in the interest that you charge to someone. Is that right?
Yep, I would agree with that. That's exactly.
So this is something I hear your colleague David Bahnsen talk about a fair bit when he's talking about capital structures and so on, and that the phrase "cost of capital" relates to the idea of interest, right? So if you're a bank and you lend money to somebody, the interest that you're going to charge, obviously there's a market rate which is set competitively, but it does relate to the cost of capital. Can you just speak to that issue, just to clarify that terminological point for us? What do you and other economists and financial professionals mean by that phrase?
Well, I mean, the cost of capital is if you were to borrow money, that you can. The way I would think about it is you can look at the lowest form or the shortest term form of what a Fed fund rate is, which banks are lending to banks overnight, is the lowest cost of capital. And then from there, you go to 1 year, 2 year, 3 year, 10-year treasuries.
Right.
And you have a market that dictates what money costs to borrow it. The lower the money, the lower the interest rate that's in the market, the more people will lend, the more the money gets flushed into the system. And when the cost of capital gets higher, i.e., when interest rates go up, there becomes less money supply in the economy. That's why when you have inflation, one of the tools in the Fed's tool belt is to raise the cost of capital to lower the velocity or the supply of money within the economy. Mm-hmm. And so the cost of capital is just simply whatever money is worth with its time, right? With risk-adjusted premium, with whatever the money is worth as it gets into the economy if you're to be lent.
Gotcha. Before we jump into that issue itself, and because that issue of the time value of money, so to speak, that raises a really significant biblical theme, which I want to come back to. But you made another fascinating point, which I guess is obvious as soon as we think about it, but must be much more obvious to you, that being involved in an economy where lending and interest payments are involved is just unavoidable. And you said, like, even if you just deposit money at the bank, you're involved in an economy whereby parties are lending to each other. Can you just flesh that out for us and tell us, what happens if I go down to my local bank and put $1,000 on deposit? How am I involved in a lending and interest charging economy at that point?
Yeah, I mean, everything that we do in this economy is based off of debt. We are a debt economy. It doesn't mean that it's bad. It just is. I mean, one of the things that we've seen the last couple hundred years is debt, and the amount of debt that we have, right, that goes into an economy has also helped again, trying to frame this in a way that makes it simple. I would just simply say that if a Christian says, "Hey, I want to avoid this," I would simply say it's completely unavoidable. Whether you put money in a bank account, if you deposit $100 into your bank account, that $100 that bank is going to take. There's a margin of it to where they can take, and then they can take it and they're going to lend it out. Right? You still see your $100, but it's in their stockpile of what they call cash, and then they're going to have it lent out. Right? In its most simplistic form. So even that. But if you have a credit card, or if you get a mortgage, or if you get a car loan, or you think of all of these things, right? Mm-hmm. That they're just completely unavoidable. That debt, and it's normal. And there's good debt and there's bad debt, and that's where there's nuance, there's wisdom. I mean, but everything you do as far as your clothes, the tires on your car, the companies that you're buying from, they all have good debt on their balance sheet. Fortune 500 companies have debt on their balance sheet. And they're using that debt, right, to go and do stuff within their own business to make more money and then to supply more goods to you and me and to everybody else. So we look at debt sometimes as Christians and say it's very negative, but I would just simply point out that debt has helped the human flourishing of the last 200 years in the American economy in particular. And so there's nuances to that. There's obviously over-indebtedness. David and other economists talked about. But what I'm just simply saying is that debt in and of itself is not bad. And so there's good. So we
need those nuances and distinctions. It's fascinating, isn't it? Because you might easily think, if I go to my bank and I say, I want an account that doesn't pay me any interest, so I'm not receiving any interest, I'm just going to give you $1,000, you've got to look after it for me. Even in those circumstances, what's actually happening is that the bank is using the money it makes out of interest from lending your money to pay its own costs. So even if you don't see any of the fruit of it as the depositor, still what's going on, and it's fascinating. You're right. You go to Walmart, you buy a bag of apples or something. You're probably buying fruit that was bought with borrowed money.
Yeah. So your cell phone. I mean, you can think of a company like Verizon, right? Just using your cell phone company. You can look up their debt and their balance sheet. They have a lot of debt in their balance sheet. And the way that their debt is structured, you can look at it and say, yeah, it's actually good debt. It's good debt. The cost of that debt is good. And then you see what they take that debt and then they go and reinvest or use it within their company. And it makes their shareholders money, and B, it produces phones, and C, people can communicate. And that's all based off of, Verizon using debt. And they're using it in a shrewd in a positive sense way. And that's what every economy, every Fortune 500 company, within the S&P is leveraged to some extent. And the question becomes, how do you use it? What are the terms? And the way that they're obviously trying to use it is to say, we want to take this money and then make more off of it than what we're paying in interest and reinvest it in the company, which then produces goods to fellows like you and I.
Right. Well, let's just jump into some of those distinctions then that help us to distinguish between good debt and bad debt. And one of the things that strikes me, if you read the book of Proverbs in particular, that you have this constant underlying awareness of a get-rich-quick mentality. So, I mean, I was just reading through the Proverbs again in preparation for talking with you. And so Proverbs 21:5, the plans of the diligent lead surely to advantage, but everyone who is hasty comes surely to poverty. And it's just fascinating. I mean, you've got other texts in the same context where the hastiness to make money, the get-rich-quick attitude, which is short-term and doesn't recognize that what actually needs to be done is long-term labor to build capital. In contrast with something like, I mean, you mentioned a company, Verizon, but let's not pick them as an example. Just pick any company that says, well, if we borrow a certain amount of money now, we think that we, by working hard and intelligently and wisely, can generate a higher return on this capital than we're paying in interest to the lender. So the lender is happy because he's getting a fairly secure investment, maybe 4 or 5% over a couple of years. The company itself is happy because they've got the capital, they can expand more rapidly, and maybe they can generate a 10 or 15% return, which goes to their shareholders, their employees, it benefits their customers and so on. So does that give you a framework as a financial professional for distinguishing between some kinds of bad lending or bad borrowing and other kinds of good lending, good borrowing? Talk to us about the kind of criteria that you would use in advising people or advising companies in that space.
Yeah. So I'll even break it down from companies to just people, right? We'll say like a household. So you're a 25-year-old and you listen to Dave Ramsey and he tells you to pay off all debt, right? First and foremost, because all debt's bad. Just to use an example, this is not a knock on Dave Ramsey at all. But this is the stereotype of kind of what we're talking about. But when you were 25, you got a mortgage in 3 years ago and you locked in a 2.25% 30-year fix, right?
Right.
The worst thing that person could do is pay off their debt quicker.
Right.
Why? Because they can take any of the excess money that you were going to took to principal to your mortgage, and you can put it in a money market account and you'll double it, right? Your mortgage is paying 2.25%, it's fixed. And then you put the money that you would have taken to pay off additional principal of your mortgage, put it in a money market, it's making 5%. You have what we call a positive arbitrage of 2.5%. That is wisdom. It's just being wise, saying, okay, this structure of my debt on the 2.25% 30-year fix is a great structure. I won here. I'm going to make the minimum payments faithfully to the bank on the terms that I agreed upon. The loser in this is the bank. They want you to make principal payments. They want this loan off their balance sheet because they want to take that and then they want to have that money reinvested at 7 and 8%, what current rates are now. So the bank is the loser in this situation. The winner is the person who has the contract of a 30-year fix. But the simple thing is, this is what businesses do. Of what your example is, you can just go to a more complex level of a Verizon or just any Fortune 500 company. It's the same principle. I have this agreement, this contract. Here's my rate, and then what are current rates? What's the current environment doing? And if you can take that in a safe investment, even just as a simple example, and make 2.5–3%, that would be wisdom and prudence.
Right.
Rather, it would be foolish to pay it off. Your point with the Proverbs thing of the hasty investments, I think of things like current day would be like crypto as an example of that, or what we call fear of missing out. This kind of momentum driven. Why do you want to do it? Well, because my friend did it and he made $20,000, and I want to be a part of and do something like that. So you're trying to hastily gain and make money off a quick interval. Proverbs is right. It's unwise. It's foolish. You could do well, and you could get really hurt. And the norm is that people normally get hurt in things like this.
Right.
And so, yeah.
No, it's interesting because your example of the mortgage, where the guy has, been blessed enough to be able to lock in a rate under 3%, and now we're in a much higher interest rate environment. It strikes me there's at least two things that are presupposed in that situation that make it a good thing. And the first is that is a loan that's backed by an asset that is worth more than the debt, right? So I've heard David say this, and I know it's something that you've you shared, that we should be thinking of a home, a property, as a place to live, and not primarily as an investment. And so it foregrounds the fact that you've got bricks and mortar there, which secures the debt. And that makes it different from, let's say, if you just went out and borrowed a sum of money at 5%, hoping that you'd be able to make 7.5%, where you've got no asset to back it. And it'd be interesting to hear your reflections on that distinction. The other thing, of course, that's obvious is that somewhere along the line, you must be making some money by working, presumably, to make the payments. In other words, the fact that you'd advise somebody to keep their, let's say, $200,000 mortgage does not mean you'd advise the same person to keep a $3 million mortgage, right? If they've got a home which is huge, bigger than they need, the mortgage payments are bigger than they can afford, right? They made a mistake in purchasing that, right? So servicing the debt is something that their current work doesn't allow them to do.
Yeah. Yeah. When you bring up Proverbs and the tension that the Bible has to say that there's good loans and there's bad loans, there's good debt and there's bad debt. We can get into all these nuances, which is good. What the scriptures are saying is that the particulars matter. The particulars matter, the terms of the debt, how you service the debt, how much money you make, your balance sheet should be a part of this. And I think that's the tension here too, of saying, like there's good debt and there's bad debt. To your example, if you have somebody who has a large home and they can't service the debt because they jumped into something that they couldn't afford, which would be in reality be harder to do in this environment and easier to do in 2004 as an example, which of just stated loans, and you can kind of do that. But you see the human nature, what happened in 2004, you see human nature on display of human beings borrowing more, right? Before the 2007 and 8 financial crisis that we had. Why was that, right? You have a bunch of borrowers, people who go out and get loans at that time because they wanted the house, they wanted to, they wanted the asset, but they couldn't actually service the debt. You had a bunch of people doing that simultaneously throughout over years, and it plunged our economy into a major crisis. Both the banks, but also the borrowers. People forget the borrowers are also to blame. The folks who are going out, getting $1 million loans when they're making $35,000 a year. There's a foolishness that's there, and so you have to be able to service the debt. That would be bad debt, and so understanding your job, your vocation, your trajectory, how secure is your job, all those things I think should be a part of your thought process when getting debt, and then saying, how can I service it? What does my income look like? How much of this debt is a part of my actual cash flow, right? So it's normal now for somebody to get a mortgage, and that mortgage to be 45% of the value of their paycheck a month.
Oh, wow.
It's really high. And so, so if you get a loan, the underwriting for a mortgage loan right now, they'll typically say they want your DTI, your debt to income, to be at 45%. 45% of what your cash flow is. It's really, really high. So the bank will approve it. Should the Christian do it, right? Well, no, the Christian, I would say, shouldn't do it, even if you can get approved there. But the Christian should do it if you can get approved there, because you're on a trajectory of making more incrementally, year after year. You know that, and that's secure. You're making an informed risk, decision. Of saying, I'll do this now. It'll be tight for a couple of years, but I'm going to work my way up here, and it's realistic. Well, then this is where the Proverbs and I think the Psalms would say, there's wisdom here, right? There's no black and white. There's no, if it's 35%, then do it, pull the trigger. If it's 45%, then don't do it, don't pull the trigger. There are other variables to be had in there. So,
and it's striking as well, just thinking about that. Trying to imagine myself being 23 years old again, and you could easily imagine, couldn't you, saying to somebody, look, maybe your income will increase quick enough to make this large payment work in 2 or 3 years' time. But there's another way, isn't there? There's a way of saying, look, why don't you live off rice and beans in the cheapest place you can find for 2 or 3 years, and just save every penny you earn, work 2 jobs, and just learn the biblical virtue of patience. Because what you're then doing is you're guarding yourself against the psychological and actually the spiritual, really, risk of being driven by greed and that kind of hasty to get rich, rather than being willing to be patient and live in a modest way for a long period of time, so that you can then make a more prudent investment. And then suddenly you're not at 45% debt to income, you're down at 30 because you've actually put a bigger down payment down. That's right. You mentioned the dreaded FOMO, fear of missing out. And obviously this is a huge driver of investor behavior. And I would love to hear you talk about that. I'm not asking you to tell any particular specific stories, but in the crypto space, but I guess also it must be in the kind of the whole hot stocks industry. People see an advert on Facebook or a video on YouTube where a guy's saying, look, I've got one stock tip, which is the only thing you need to get rich, and just sign up here for my proven method, and then he shows you some screenshot with a bunch of numbers on it that shows you how much he made last month. And people feel like, oh, if he's done it, I could do it. Or they've got a friend at work who says, well, look, I've got in on this scheme, and it's not really a registered investment, but it's look at the returns. Like it's promising 30% a year. And there's something in the human spirit, isn't there, that doesn't want to miss out on what looks like a great opportunity. So there's that fear of missing out. Talk to us about that, and I'll try and avoid having you shed a tear and holding your head in your hands over the investor behavior issue, because that must be a lot of what you spend your time trying to manage.
No, I think I'm glad that you brought it up, and you've heard me talk about this, offline, and it's no secret. I honestly think that the worst enemy of an investor is our human nature. And now the audience who's listening to this podcast are all good Calvinists, so we're all we're all understanding and of the doctrines of original sin and total depravity. And we're the only people who are proud of that too, by the way, which is real weird. But as talking to a bunch of Calvinists, as myself. Or as I myself am, and I know you are, it is intuitively and empirically a fact. Just being in this world of managing client capital and managing the worst enemy to an investor is human nature, and a huge part of that is what you just described, right? So greed sets in. This, my friend invested in crypto, and he has, he did $20 turned into $20,000. Then you think, my goodness, I want to do that. It seems easy. So it's this appeal to immediate gratification. So as Calvinists, people who understand original sin, as Luther says, we're bent in on ourselves. We are prone to immediate gratification. We are prone to leaving the mandate of working diligently and putting our nose to the ground and faithfully going and cultivating and doing stuff because we want to abdicate our responsibility as being hard workers and serving our neighbors through the vocation of work. We want to stray away from those things because we're just sinners, all of us. Right? So all of that intuitively makes sense. When I got into this profession, I was like, wow, God's really, really right about our behavior. And then you see it when money is on the line, you really see it kind of come out. And so all the things that we think about, greed, fear of missing out, all of those things are intuitively true. And intuitively obvious. You can give a million examples. So David would give the .com crash. That's an example. The Beanie Babies craze, the 1990s. Your Beanie Babies, selling for astronomical amounts of money. And people say, well, I sold it for this much. It's, it's good. And same thing with crypto. I bought it for this much and I'm selling it for this much. And so just because you buy something or somebody buys an asset and then they can sell it for more, as you said, when somebody sees that, it's easy, it's immediate gratification, that should be signaling red flags to us. We're good Calvinists and saying, this doesn't make sense. I had a friend who once said the grass is greener on the other side because it's fertilized with BS. He used the real word, but it's true. Yeah. And so this idea here of fear of missing out, if you have an investment that is immediate, if you have promised returns without discussing the real trade-offs that are inherent in the investment, all of those should be red flags and you should run from them. Right. You really should never do it. And so fear of missing out is huge. Human nature is the worst enemy of an investor. And jumping into things that sound too good to be true, just know that they're always pretty much too good to be true. And so I can give particular examples of, again, the crypto thing I think is a great current example because what is it? It's nothing. It's literally nothing. There's nothing inherent in crypto. There's no inherent asset of it. It just does. It's I'm going to buy it on the assumption that somebody else is going to buy it for a higher price. And that is what you call a Ponzi scheme, or that is what you call an immediate gratification. No, it's a Ponzi scheme. Mm-hmm. And so I'm going to buy it because I think somebody else will buy it at a higher price. Well, why should they buy it at a higher price? Because everybody doesn't want to miss out. And you have all these people jumping in and not wanting to miss out, and they keep buying it for a higher price. It's called the greater fool's theory. It's a real thing, right? call this the greater fool's theory. I'm going to buy an investment because somebody else is going to buy it at a higher price. And you would think, well, why are they going to buy it at another price? Because we've created this fear of missing out, of people saying, well, I want to jump in. I can get in the early stages of this and make money. Then I'll jump out and sell it to somebody else at a higher price, and I'll make my money, and then it's going to go on. So people can make money from it. Typically, it's the exception, not the norm. And then most people, once that bubble pops, they're going to get their faces ripped off, and they're going to get hurt, and people are going to feel that. And you see it with the Beanie Babies craze, the dot-com crash in the early 2000s. In history is ripe with these examples. There's a great book it's called The Extraordinary Delusions of the Popular Opinion by Charles something. I'll give you the thing, you put it in your show notes.
Yeah.
One of your favorite books, but it's an example. It's like 300 years of just this type of stuff. Here's an
Extraordinary Delusions and the Madness of Crowds or something.
Thank you.
Yeah.
Yes. So.
Yeah. I want to just put a footnote in here because the whole crypto space has been populated, among others, by Reformed Christians, and I think there's an additional factor that pushes people towards this, in contradistinction from the theological convictions that ought to drive us away from it, which you mentioned. I think there is a contrarian and anti-establishment streak in many Reformed Christians. We tend to be mistrustful of elite and establishment solutions to things. And so for an example of that would be fiat currency. There is I think justifiable to some degree, frustration with the devaluation of our currency over many decades. And so crypto sells itself in part as an alternative to that, which raises this question of what the crypto advocates actually say it's good for. I was fascinated. This is the footnote, really. David had a podcast on his Capital Record podcast recently where he interviewed a guy, I can't remember who it was, but he'd just written a book about crypto and Bitcoin and so on. And it was really intriguing to me because I'd heard a lot of people making the case for what cryptocurrencies are good for. So obviously they're not a physical thing. There's no asset there, but they're a safeguard against government interference, or they are a store of value, or they are a medium of exchange in contexts where other media of exchange can't function. And I just want to encourage anybody who's got those questions to check out the Capital Record podcast with David. It's a couple of weeks old now, this particular episode, because there is more to say in that space. And I know you've got a lot more you could say, but I want to keep us on track on the debt thing. I just have a feeling that maybe we should have another podcast and you should talk to us about crypto, but not not today. Talk to us about student loans. Let me set the stage for this by saying, obviously, if we piece together what you've said so far, clearly there's such a thing as good debt and there's such a thing as bad debt. One of the characteristics of bad debt is that you're taking on a level of indebtedness that you've got no realistic means of paying back, or as you look to the future and try and weight the probabilities of the various outcomes, the realistic likelihood of you being able to pay this back and make a return on the investment that makes the indebtedness worthwhile is really low. Whereas if you've got a situation where you're taking on a manageable amount of debt and there's a high probability of that allowing you to generate a future income stream which pays back the debt and then generates more profit on top of that, that's good debt, right? So student loans, good debt or bad debt, or potentially both? Talk to us about that.
Yeah, the one word answer I'd say it depends. And again, here's this tension. There's good debt and there's bad debt. So we've established that, right? It's not that debt is bad, it's the structure, the terms, and the nuances. So I'll give you an example of good and an example of bad and then push back or ask questions from there. But I'd say, you have a Jane Doe who's going to New St. Andrews. We use that as an example. You're going to New St. Andrews.
One purely random example, right?
Just a random example, yeah. One that your audience won't understand. You have Jane Doe who goes to New St. Andrews. She is desiring to be a wife of someone that she doesn't know. yet, right? So the husband's to be determined. And she wants to go to New St. Andrews because New St. Andrews is going to explore the true, the good, and the beautiful. The end of education for the sake of education is why she's going. All of those things I'd say noble. I love it. It's chef's kiss. Great. But she doesn't have the means to pay for it. Let's just pretend New St. Andrews is 100,000 a year. It's very affordable, so it's not, but we're just going to pretend it is. Or it's like a private Biola. It's 40,000 a year. If that was the case and her parents couldn't afford it, she doesn't have the capital, I would say don't do it. Don't do it. You yourself are going to go into a vocation that is noble, true, and good and beautiful, and being a homemaker for a husband who you don't know whose income is going to be. I would refrain. If you can't afford it now, I would be very hesitant in that situation, right? To take out $100,000 and some odd $1,000 of debt,
right?
With a bunch of unknowns. But then you go John Doe, who is example 2, who wants to go to a trade school to be an electrician. Mm-hmm. It's going to cost him, let's say, $100,000 total, right? $150,000 total. I don't know what it costs for a trade school. Just make it up. But we know that John Doe as an electrician is going to do very well within year 1, 2, and 3. He's going to probably make it $80,000, $100,000, and then, potentially, because it's a niche trade, he's going to start making good money right away, and then he has the upside on that. So, almost unlimited, it seems. Go into his own vocation, start his own business, and so forth. Good debt, smart, because here's where the nuances of all that are just so important,
right? Right.
And so I'm always perplexed. The wisdom literature of Ecclesiastes, Proverbs, is always, it's never black and white. It's just not, because east of Eden, we live in a really, really sinful and complex world, and it just takes a lot of wisdom to navigate. The scriptures are really clear about that, and that wisdom starts with the beginning of the fear of God, and then also walking and understanding and leaning on elderly people, the church, and all these resources that are given for that. But experience is a big part of that, and there's no black and whites. The older I get, the more I realize there's no clear. There's the details matter.
Yeah, that's fascinating because and it's kind of reassuring, Drew. I've got to tell you, because it mirrors the kind of thought process that we've been going through with our children, and that many other Christian parents go through with their kids. Now, as it happens, so I think you know this. Obviously, you know this. We know each other quite well. I have a son who's 20, a daughter who's 18, and a daughter who's 16. The older two are at college. They're both doing STEM subjects. The oldest two. And on the face of it, you think, okay, so that's a good investment of their time. Also, as it happens, they've not needed to borrow at the present time in order to attend, because they've done really well. They've got some scholarships. We'd saved a little. We're able to help them out with that. And they're also working to get their way through it. Now, but at the same time, it's still a cost. Like, if college was free, it's still costing you the lost income. Like, Ben could have been working for 2 or 3 years by now, doing all kinds of different things, whether here in the US or back in the UK, where, as all our listeners can tell, probably that's where we're originally from. There's any number of different ways that he could have been earning money. And what people often don't see is the money they don't make. And the reason they don't see it is precisely because they don't make it. So there are all these costs loaded into the cost of a college education or a trade school. And then you layer on top of that the different anticipated outcomes and the uncertainty in those outcomes. And it's just fascinating, the 2 examples you picked, Jane and John. Obviously, there's uncertainty in both. John might get injured and never be able to work in his trade. Jane might get married very quickly to somebody who's very wealthy, who could easily pay back the money that she'd spent on his behalf before meeting him. Or she might not get married for 10 years or 15 years or never at all. And the question then becomes how you navigate the decisions you've got to make now in relation to the future, which is uncertain. And it's this issue of indebtedness is one layer of that complexity. And so the kind of path that we've taken is to try and say, okay, we don't know what the future holds for any of our kids. We know what their aspirations are, and we've talked to them about that. And I've talked about this with other people and their children as well. But what we want to encourage them to try and do is try to make decisions in the present which will not turn out to be disastrous regardless of what the future holds. So you're trying to make anti-fragile decisions, in other words. You don't know the future, but let's imagine the Jane Doe situation. If you've got a young lady who's, if it turns out she's going to get married and she gets halfway or the whole way through a degree, but doesn't incur a huge amount of debt, even if she's missed out on some earnings, nonetheless, that's not a disastrous outcome. That's a good outcome because there are some positives from the degree. If she doesn't get married for 10, 15, 20 years, that's also a good outcome. She's got some training and so on and so forth. Yep. What you don't want to be doing is putting yourself in the position of six-figure debt and just sitting waiting for a preferably wealthy Mr. Right to walk into the coffee shop where you're working. Because then you're in a fragile position.
Yeah. I can give an even more specific example I think is more common. Take a teacher, noble and good profession.
Yeah.
You see people who go and they get a undergrad and sometimes masters, and they rack up 40 to 70,000 in debt. And you know that your vocation is going to pay you 35 to 60,000 a year. You know that.
Yeah.
And so again, good, noble profession, but is it worth, and that's, again, it's not a hard stop, right? I'm not saying no, I'm just simply saying like, that's one where you look at the indebtedness and then you know what your income's going to be as a teacher. And you look at that and say, is that really prudent? Is that really wise to take out that much debt to go and work in a vocation of making 60,000 a year, to where servicing that debt is going to be somewhere around 20% of your income.
Right.
And a lot of your income.
And it's a tough thing, isn't it? Because truth is, for a lot of people, the math is not easy. I mean, for someone in your position with the experience you've got, and certainly for someone who's got a STEM background, the math is not difficult if you think to do it. But for a lot of people, just working out what will be the actual long-term cost of incurring a certain level of debt, alongside foregone income, like potential future changes in interest rates and so on and so forth, that's actually not an easy piece of math to do. And presumably that's why people would be wise to get financial advice if they're in the kind of position to recognize that they're in a position of uncertainty and to seek advice, right?
Yeah, great.
I want to talk about a couple of other issues. In a moment, I want to come to a particular investment philosophy that you espouse, and you didn't know that I was going to ask you about this before you came on, and so there's, in no sense is this Drew Dill feeding us unsolicited advertisements for his firm. What it really is me saying in a moment, asking you to describe what you actually advise people to do and the kind of approach you take to investments. But before we do that, I want to talk about something which is just another question that comes up in conversation with congregants here. And it's the issue of leveraged investments. And let's take a very, very stark example of this. Imagine somebody in his mid-20s or early 20s, and he sees people making money out of capital that they've earned and that they're then putting to work in some productive way. And somebody shows up with a scheme that says you don't need any startup capital. What you can do is something. And what it amounts to in the end is either explicit or implicitly leveraged. You're borrowing from somebody in order to put money into normally their investment. Can you talk about this kind of approach to investing and what you think of it? Good, bad, terrible, what the warning signs are and so on?
Yeah, and I just want to make sure I got my terms correct, because when I hear leveraged investing, you can go, you have a leveraged S&P 500 with a 2-to-1 ratio, which means whatever the S&P does, you juice the returns by double. That's not what you're talking about here. You're asking for somebody who comes to John Doe, who's 20-something years old, and they say, hey, John, I got this great investment idea. You don't have any skin in the game. You don't need to put any skin of your capital in. We're going to give you money and let you borrow our money so that you can make an investment and then you can repay us back. Is that what you're saying?
Yeah, I mean, you could talk about the 2-to-1 S&P trackers if you want, because I know you've done the math on that and have some fairly sharp opinions about them. Do you want to do that first, and then we'll talk about the leveraged investment scheme?
I'll go with the leveraged investment scheme first. I just want to make sure we weren't talking about the leveraged ETF thing.
Yeah.
But I'll jump to the one that you had first.
Yes.
For something like that, A, again, if it sounds too good to be true, it just is. B, if somebody's asking you not to put skin in the game, and then they're giving you money, you have skin in the game because they're giving you money and you have to repay that, and they're doing it for an economic reason. And so right away, I'd say, not smart. Don't do that. Don't take somebody else's money when they're promising you, right, that you're going to do fine, you're going to make money. That was, I think, the situation.
Right.
You're going to take somebody's borrowed money. So you're borrowing money, and then you're going to go invest that money, and then you're going to get the returns, and then give the difference back to the person or principal, whatever interest you're charging. You know, when people think of like the great financial crisis, the depression in the 20s, we have margin lines. You can kind of borrow from a brokerage account. And it's the same idea. There's people who want to borrow money and then they'll invest it. You have a margin line. There's good and bad ways of doing that. And to say, though, in this case, that person would be 100% margined already because they have no skin in the game. If you follow, so
yep.
you have nothing. You're just taking 100% borrowed money and then you're going and investing it. What happens is that you have the potential to invest it in something, and let's say it blows up.
Right.
Now that investment blows up, and then you owe this person whatever they borrowed or gave you, plus whatever interest and so forth. It's a very bad idea in that case.
Right. You mentioned leveraged ETFs. So just to get people up to speed with this, so an ETF, exchange traded fund, it's a way of buying a basket of stocks that tracks normally an index or a sector or a part of a group of companies, perhaps. And normally what happens is you buy this bunch of stocks, and as they all go up, your fund goes up in line with them or goes down in line with them. So what's a leveraged ETF? And tell us what you think about them.
Yeah, it's when they borrow money and they double down for returns. It's essentially what you're doing. You're taking leveraged money, additional, well, not just buying the stock, but you're borrowing money to double down on those returns. And so you get double the risk, double the reward, or double the loss. And so that's the easiest way of thinking about it. And inherently, with just any investment, right, understanding that there's no free lunch, as somebody once said, there's a risk premium that doubles in something like that. And the index is going to be the key of whatever you're investing in. So you have leveraged S&P 500 indexes where essentially you're buying the S&P and then you're doubling down on it by leveraging the S&P with borrowed capital, ergo, double the returns, double the losses when they're there. So
right. I'm just trying to remember how the math works, because if you buy a standard ETF tracking the S&P 500 or the NASDAQ or whatever, if the fund goes up by 1% and then comes down to where it was before, so it goes from, let's say, 100, 101, back down to 100, the normal ETF should end up where it started from. But a leveraged ETF will actually end up lower. Is that correct?
Yeah, and I actually don't know, and this is I'll confess my ignorance. I don't even know the math on hand because we don't do it at all. So I'm so far away from the space. I don't know the math off the back of my hand. And so I'm not going to attempt to do it because I'll make myself look like a fool. Get it wrong. So I'll divert from the math of it, but the idea of the concept, that's what it is.
Right. Okay.
Borrowing, and the losses are far more extreme. That I do.
Right. So. Yeah. Well, let's move on, and this is the final subject I really want to talk about, because so we've talked about loans. I mean, we've not talked about credit cards, but I guess that sort of stands to reason that if it's the easiest money you can get hold of as a borrower, it's the money you're going to be paying most for. So have a credit card, but pay it off every month. Would that be your advice?
Yeah. I mean, I don't recommend credit card debt is debt you don't want to hold.
Right.
It's always bad debt. You can use credit cards to pay it off for rewards and things like that. And again, I don't think Christians should have any sort of allergy to that. It's like, no. If you have a credit card and you want to, you put $2,000 of expenses a month because you're just going to pay that off in cash at the end of the month.
Right.
You're not paying any interest. You're paying no interest. It takes 30 or 25 days after you make a charge for the interest to start accruing on the debt, on the credit card. Pay it off at the end of the month. You don't pay interest. You get rewards points. That's prudence. That's just being shrewd, again, in a good way, right? Just being wise. Now, the reason that credit cards do what they do and offer points, you and I know, is because credit card companies and banks understand human nature better than some Calvinists.
Right.
They know that if they offer the population short-term immediate cash flow, that a lot of the population is going to over-lever themselves because they want whatever it is that they want, and they want it now, and they don't have it with their cash flow, so they're going to borrow with their credit card. So Christians and non-Christians are susceptible to this, and that's where it's like, no, that would be, don't do that. Don't borrow what you cannot afford.
Yes.
There's exceptions, there's nuances, I get it, but just as a general reason or rule of thumb, that's what they're doing. And credit card companies do this. They offer point systems because the bulk of people borrow more and they hold balances and they're paying exorbitant interest rates, which is not a blast on the banks. The banks are at risk to it because it's unsecured debt. There's nothing to it. You don't pay it. It just goes bad. You get a bad credit score, and there's nothing they can do. Nothing to repossess. But it's them understanding human nature and what people do. And I think that's a fascinating point, is that, our secular neighbors understand this very well.
Yes. Yeah. So what should we do then? And be as explicit as you like. We have here a congregation of several hundred people, including a large number of young families and a bunch of families with teenage children, and then older families, some single people. We've got some young folks growing up. I would love for them not just to be working hard and seeking to save and provide for their families and to be generous to others. I'd love for them also to have an idea of some principles that should govern their investment. I'd love for them to be godly and wise and hardworking and wealthy. There's nothing bad about that. And just imagine for a second that you were a wealth manager for somebody like that. It was quite easy for you to imagine. Can you describe in outline the kind of approach you take to selecting investments in particular? I'm not asking you to recommend a particular portfolio because obviously everything's personalized, but talk to us about the approach to investment that you guys at the Bahnsen Group embrace. Yeah.
So we're dividend growth investors. That's the kind of the cornerstone of how we allocate and how we think of investing. So we're, from a philosophical standpoint, we invest in companies, so stocks that pay dividends, and more importantly, they grow their dividends year over year. If you kind of think about everything we've been talking about, human nature, speculation, FOMO, get-rich-quick schemes, this is like the antithesis to that. This is not a get-rich-quick scheme. Doesn't mean that it's a quote-unquote conservative investment. Doesn't mean that it's not going to grow a lot. It doesn't mean any of that. It's just saying the philosophy embedded in itself is geared for long-term gratification, right? Longer term faithfulness, steady at the wheel, right? Type longer time horizons. Not invest here, then you're trying to pop a 20% return at the end of the year. It's not what it's going for.
Right.
And so the idea is that you invest in companies that pay a dividend, which is you buy a stock, and some stocks, not all stocks do this, but some stocks will pay. If you own a stock, will pay you a cash flow dividend. So you can own a stock for $1. There's some stocks will pay you 5%. 5 cents every year on that $1, 5% yield, right? Of the stock in this case. We want to buy companies that are paying that 5-cent dividend. This is just an easy example of the dollar. So 5% yield, just making this up. And then we want the next year that 5 cents to turn into 7 and 8 cents and 9 cents. We want that dividend to grow. We think that if that grows, the price of the stock over time, right, will also grow, right? And if you think of the investment philosophy of why we like that, there's a lot of reasons why, but speaking to the audience that we're speaking to now, we think of things like Enron and scandals all throughout financial history, even in big Fortune 500 companies. I think, we remember Enron was 15, 16, was it almost 20 years ago, where you have this major company, was publicly traded, go bankrupt because they were lying about their balance sheets. They literally lied about how much money they're making. They lied about everything. And a lot of people got hurt. The company went bankrupt. Well, how do you avoid something like that? Well, if they were paying a dividend and growing a dividend, well, they wouldn't have been able to do that because they were lying about their balance sheets. The companies that are actually paying a dividend and growing a dividend, they can't lie about their balance sheets because they're paying shareholders here and now every quarter.
Right.
A cash flow. That's one reason. So I'm speaking to Calvinists who it's like we're skeptical of businesses and big corporate greed. One of the ways to keep them in check is to say, well, I want you to pay me something now for my current stock investment.
Right.
And so that's what we're saying there. And so as a philosophy, we want companies that are growing revenues. They're building real products that go out and actually help people, from cancer research to your Cheerios in the morning, to diapers, to think of real, to oil, to energy, all of these things that produce good things for our human brothers and sisters, Christians and non-Christians alike, that promote human flourishing. They actually produce tangible goods. They get money for those goods, and then their revenues grow, right? Which means their earnings and their revenues grow ultimately. And then they repay those revenues and earnings to people like myself and investors through the form of a dividend. So you get this, you can't lie on your balance sheet, and then we're not speculating. We're literally going off of earnings and cash flows and bottom-up type investing. And so, again, it's the antithesis of everything we've been talking about on the FOMO side.
Right.
So, and I'll elaborate more. I feel like shotgun spraying.
It's really helpful. It's really helpful. It's striking because you could parse it theologically and just imagine yourself as an investor, 25, 30, 35 years old. You're saving some money every month from your paycheck, and you want to invest it in a company that shares your values and is likely to make a return in the long term. So how do you do that? And it strikes me that one way of parsing what you said is that finding companies that do what you've described is a way of ensuring that the management's competence and goals aligns with yours. So they can't pay a sustainable growing dividend over time unless they are working hard to make real products and actually committed to returning that to the owners of the company, the shareholders, and they're not lying about it. I mean, and this is the thing, if in a sense, we want to encourage people to be extremely suspicious of everybody. So how do you overcome that suspicion? Well, you say, well, you prove to me that you're making money by giving me a share of it.
That's exactly right.
Right.
And well said too, because you elaborated on a point I didn't hit on, and I think it's absolutely prudent, is that you brought up the fact that this philosophy of, if you have, ABC company that's paying and growing a dividend, it keeps the management and the board very disciplined. And it keeps them accountable. It doesn't just keep them accountable from an honesty on the balance sheet thing. That's check one, and that's just a fact. You have to put your money where your mouth is and pay shareholders on a quarterly basis. But it also keeps them disciplined by staying in their lane and producing what they're really good at. It prevents them typically from going and buying stuff and then leveraging out, right, to go and, like AT&T is a great example when they bought, I think it was Time Warner. The telecommunications company buys a TV streaming, right, thing. It's kind of out of your lane. And then to lever up and to go do that, those are things that, right, are things that you, if you're paying and growing a dividend, now you're putting a lot of stress, because now you have to go and execute on a whole different line of business, a whole different competency. It can be done. I'm just giving this as an example and saying, well, that's going to be hard to grow and sustain a dividend. And by the way, that company didn't grow and sustain a dividend after they did that merger. They cut it 18 or 20 months after. But that's exactly the point, is if you're growing and paying a dividend, from a management standpoint, it keeps them in check and it keeps them disciplined from going and buying and doing foolish things with the additional revenues that their companies are having.
Yeah. Drew, you've been very generous with your time and very insightful with all your comments. I'm very grateful. I want to thank you on behalf of the congregation here. Just before I let you go, I wonder if you could point us to some resources that people could look at if they wanted to read more. I mean, particularly about where we ended up, the whole investment strategy piece, because that's right at the heart of your your line of work. It would be remiss of me to let you go without recommending stuff. What would you encourage people to read, or where would you encourage people to go if they wanted to find out more about what you've been saying?
Yeah, I think the greatest place to start is the owner and founder of our company, David Bahnsen's Case for Dividend Growth, that will elaborate the investment philosophy that we think is prudent for investors. So I'd be remiss to not recommend David's book. And I would say all of David's books, but that one particularly for an investment thing, or for an investment standpoint. From the banking in the loan stuff, I think a great book, if people are really interested in the congregation saying, I want to know more about why, Pastor Steve and Drew think that leverage is good, and there's good leverage and bad leverage, and how the church has thought about this for a long time. A guy named Samuel Gregg wrote a book called For God and Profit, How Banking and Finance Can Serve the Common Good. He actually goes into a lot of the reformers' opinions in early church history on this, and then does some just exegetical work as well to explain, look, this is actually for the common good, and there's good and there's bad and there's nuance. But I think that's a great book. That's Samuel Gregg, For God and Profit, How Banking and Finance Can Serve the Common Good.
That's great.
David's a big promoter of Acton Institute and the fellows within that as well. I can't say that I've read all of their works, I've read a good amount, and I've always been very pleased with that group of people. Obviously, I'm biased, and I think my boss is phenomenal and writes good stuff. So
yeah.
that.
And there's a bunch of other podcasts out there. So if people wanted more of your boss's week by week commentary, there's a Dividend Cafe podcast. You can search for that. And then there's also, is it with National Review, Capital Record, that he does which is a broader kind of ideological look at capital markets. A free and virtuous society is the tagline, promoting a free and virtuous society, and you could listen a bit more there. If people want to get in touch with you, Drew, I'm sure they can use their intelligence and figure out how to do that. I'm not going to belabor that point. I just want to say to you, thank you very much indeed for taking the time to talk to us today. One of my passions here as a pastor, is to help Christians who really want to grow in their faith, really want to apply the Bible to the complex nitty-gritty questions of life, to do so. And you have really helped us to do that. And I have pages and pages and pages of notes here that I now need to turn into a summary of this podcast to send out by email to our congregation when it goes out, which I will enjoy doing, because I'm very sure that listening to this will benefit everyone who does. So Drew Dill of the Bahnsen Group, thank you very much indeed for being with us today.
Thanks, Steve. Thanks for the kind words. See you soon.
God bless you.